Hey guys, Jilson Day here with ChronoStory.com. Today we're going to be talking about trading halts, what they mean, and how to profit from them. So, trading halts scare a lot of first-time investors. You'll be looking at a stock or a security, and it's flying all over the place, and you'll be, let's say you have $1,000 profit or something, right? Then all of a sudden you get news that hits the street says SEC has halted trading on the stock ticker, right? This happens not because the stock moved fast, but because of an order imbalance. A lot of people don't understand that. This article is important for people to understand because if it was just based off fluctuation, there's not really much you could do. But because trading halts are done for regulated by the market, the SEC, for example, when there's a stock imbalance, either the buy side or the sell side, this is essentially you could thought of like a spring coiling up and then rapidly exploding. And if you position yourself before the spring explodes, guess what? You can make a ton of money. Uh, so yeah, in this article, I'm going to show you one of the tricks of the trade of how to predict these trading halts and actually make money off of them. This isn't like financial advice or anything. These are just methodologies that people in the street employ, uh, professional traders to like kind of squeeze out an extra 4 to 5% per year. It does require you to constantly be on top of the markets and constantly be looking at them. But if you build a couple scanners, you know what you're doing, you know how to scan for this type of like potential volatility, um, then you can start, profiting from these. And that's a secret that a lot of people don't really understand. So first, let's go over what a trading halt is. A simple explanation for a trading halt is this. Trading halt is when a government's regulatory body decides to halt trading on a security at risk of experiencing extremely rapid price movement. Why do they do this, though? Right? The main reason that regulatory agencies do this is to lower volatility over time. Studies have done, academic journals prove this, is the fact that if you have high volatility on an asset, everybody loses, right? Uh, as we can see here in this thing of bid to order, ask and balance pricing, um, if the bid and order price shoots up, then what happens is the stock will just go catastrophic all over the place. So we see that here, right? This chart right here kind of shows how volatility will grow in relation pre and post trading halt. Without a trading halt in place, the pretty much the volatility will continue to grow, and it could grow indefinitely as more and more people pour into it, and that is a major problem. Now we see here with the trading halt placed in this theoretical option, or this theoretical scenario is at 12 p.m. The volatility stabled out over time, whereas this one it shot up through the roof and then came down, assuming it didn't continue on forever. That's why trading halts exist. It prevents volatility climbs from happening indefinitely. Uh, GameStop and earlier in 2021 in January was at risk of experiencing an indefinite volatility hike. If that happens, it will literally crash the entire market, like the global economy. And the reason why is because its algorithms reprice their risk models and start pouring everything out, and selling it. People just start selling in panic, and it's a giant domino effect because anyone who's built an algorithm knows it's based off variables. If all the variables say sell, then everyone's going to start selling, and it will lead to a flash crash. One of these happened in 1987, where the U.S. market lost, I think it was like 30 or 40%, like in a day. It happens, but that's why trading halts are put in place, right? So how do we profit from this, right? That's what a lot of people want to know, and we'll get right into it. So what we know, trading halts are there to limit volatility, right? But volatility will continue to increase up until the trading halt is triggered, and then it will crunch, it will crash because no one's trading up until it rises again. Now, normally what people have been doing, I would say up until around 2008, is investing off this crash. So like think of like a lung. The volatility will grow into the trading halt, and then the volatility would crash because of the trading halt. But because we have so many retail investors in the market nowadays, uh, they actually end up trading even after the trading halt, which will lead to trading halt after trading halt after trading halt, multiple back to back to back, and this volatility increase will drastically affect the underlying stock's price. So much so that in sometimes if you see like 4 or 5 trading halts back to back to back, usually it's going up. A stock will go up like 40-50%. Trade after trading halt, trading halt, trading halt, as the order imbalance becomes bigger and bigger and bigger. Now, efficient market hypothesis is basically that all assets have to be priced accurately eventually, right? A stock will return back to where it's at. So you can do two things here. We can invest off the continuing volatility increase. This is usually done through an iron condor trade, or you can simply buy the shares and then short it. So you have the option here. You can either go options contracts, right, and you can make money off of volatility increase and thus decrease just by iron condor and then selling iron condor, or you can go long short, right? Now the long short is scary, right? A lot of people, the risk is ill-defined on the end part. If you're just an average investor, just buy the shares, right? The volatility thing will happen, and then sell. Just know that typically it's going to revert back to the mean or back below where the stock's price was. If you're into options trading, I highly recommend that you check out some of the articles on how to invest off of volatility. You'll notice a significantly higher win rate by doing it that way as opposed to just investing with stock price. Learning to predict volatility and volume and liquidity is really going to be the core thing that drives professional investors. And that's why here at Chrono Historia, I publish articles on how to generate alpha, which is above market returns. There's certain key components and methodologies that most people would be aware of. So here's the steps to profit from Trading Halt. Step 1, figure out what stocks retail traders are targeting. There's a couple great sources for this. I build my own Python programs to do this, and it web scrapes social media sites such as YouTube where you're viewing this. It'll pull the closed caption data off the website and just go through it looking for like stock tickers and stuff. You can also do it with Wall Street bets, Twitter forums, et cetera, et cetera, et cetera. The more data you have, the better off your analysis is going to be. That's just a law of building algorithms. You can use a free online web scraping tool. On Chrono Story, I've put these things out there. You can go ahead and click on them. Ape Wisdom is one I really like. It pretty much just does like Reddit stuff. And then Hype Equity is more for, I would say, advanced traders. But they both do the same thing. They just web scrape data, right? But it's just a tool that you need to be aware of. So first thing is figure out what stock traders are targeting. Just click on one of these links right here. You can figure it out. You're smart. Step 2, can a stock rise fast enough to trigger a trading halt? For this, we need to start looking at float, right? So float is a very iffy term, but float's basically the amount of shares that could move in and out of retail investors' accounts. So here we go. This is a float. I believe this is on GameStop. Yeah, so the float is 99 million, which might sound like a lot, but for most publicly traded companies, that's very, very small. What that means is if you have a volume of 200 million, you have a higher chance of an order imbalance. And the reason why is because retail investors typically only know how to buy and sell. They don't understand shorting or anything. So just let's say if 80% of retail investors just click buy, there's automatically an order imbalance. Now the issue is if the float's low, that order imbalance can become more and more and more. And what the retail investors see on their screen is that the stock price is going to increase faster and faster and faster. So they issue more buy orders as they FOMO in, and it's a snowball effect, right? So look for stocks with low float, right? And that's how we're going to figure it. Can they rise fast enough to trigger a trading halt? There you go. It's not about the stock's price. Remember that. It's about the order imbalance. But a stock with a massive float, I think Nokia has like 1.5 billion or something, just to give you a comparison. This one has 100 million. So then we need to place a trade that will profit off volatility explosion. Here's that iron condor trade I was talking about. I personally like iron condors. They're not for everybody. On average, you're going to get between 17 and 25% ROI. But the good thing with the iron condor trade is it doesn't matter which way the stock goes, so long as the volatility crunch happens. If it goes up or down, that's all that matters. So when you buy the iron condor trade, you're betting volatility is going to stay the same or increase, which will impact the underlying stock's volume because higher volatility means higher price swings. For those who don't know, the iron condor, the reason why it's called a condor is because we have one wing up here and one wing down here, and you take it when the stock's in the middle. It's like at $100 in this scenario. And as volatility increases, in this scenario, the stock will increase in price. And if it ever crosses these outside limbs with the volatility being high, it's very important. The volatility also has to be at the same or higher than when you bought it. You'll make like a 17, 25% ROI. Once you know what you're doing, the win rate on these iron condor trades is like 90, 95%. The downside is you put up a lot of capital. When you lose an iron condor trade, which you only ever really lose them if you're being an idiot, you're going to lose a lot of money. Right, to give you an idea, usually it's 10x whatever the premium is going to be. So if you're going to make like $25 off of an iron condor, then you're going to be putting up $250 to risk. You risk it to make the biscuit. In this case, you risk $250 to make 25. Doesn't make much sense, but when you factor in the fact it has a 95% chance of success, and the only time you lose it is when you're being an idiot and you don't look at outside variables. This is why a lot of professionals use iron condor trades. I like them. I play spreads and condors all the time, as well as I go long short on things. It really depends on the time of day. So yeah, there you have it. That's what a trading halt is. Remember, it's important to remember it's not based off price increase, but order imbalance. Because the SEC doesn't want to they don't want to issue the trading halt after the stocks increase in price. They want to get to it before it explodes, when the spring's coiling up. The trick is you got to figure out what's coiling, when it's coiling, and how much can it explode when it coils, and then you just invest off of it. So I hope you guys found this article entertaining. I highly recommend you guys head on over to Chrono Story to check it out. I have some useful tidbits over there, some tricks of the trade, investment research, methodology articles, stuff that's just generally going to help everybody from the novice investor to the hedge fund manager. This is what I do for a job, and I would like to think I'm pretty good at it, but it's each their own. Anyways, so until next time, I wish you best of luck in your investing journey, and this is Chosen Day signing off.